Let's get more on today's interest rate decisions. It was a bumper day for fans of monetary policy. We got announcements on rates from both the Bank of Canada and the Fed. We're joined by Carl Gomez, chief economist at Costar Group, which is a real estate data company. Thanks very much for coming on the show.
Thanks for having me.
The Bank of Canada, you can hardly blame Tiff Macklem. He just doesn't know what Trump is going to do on tariffs.
Well, does anybody really? I mean, at the end of the day, there's so much uncertainty locked into that. That's usually the playbook with Mr. Trump. So, I think the Bank of Canada just has to react like everybody else. And the good news is they did provide scenarios of what could potentially happen in their NPR today. But these are just scenarios. We don't know what the reality is going to be.
You have an interesting note for us. You say that Canadian inflation has come down substantially. And in fact, real rates of interest in Canada are still high versus the US?
Yeah, they're still above the US. That has been the case, for a long period of time. It kind of supports capital flows back into Canada. But I say that because there's still room for the Bank of Canada to cut. I think because our rates are still more restrictive on a real basis than the Federal Reserve, there basically is the potential for further cuts down the road. And it's our view that we actually think the Bank of Canada's terminal rate will be about 2.5%. So we're banking, maybe a couple more cuts. Now that's depending on the base case scenario changing into a scenario where there could be tariffs or anything else. It could be even deeper cuts. Who knows?
But if it turns into life during wartime on the tariffs, then who knows?
Well, and I think that was the impetus for the NPR to talk about scenarios, because obviously there's growth impacts, and the NPR talked about, a full substantial hit could be 3% on GDP. But there's also a one-time impact on inflation, and then there's the impact on expectations and everything else. So it's a who knows sort of situation.
You and I were discussing this just before the segment, but if the real rates in Canada are higher than the US, why is our currency so weak?
Well, I think our currency has always been a little bit weaker than where it should be, and part of that has to do with Canada's, productivity and a few other major long-term factors. But I think what's happening right now is that spread is closing in on the real rates, and it's happening on the nominal rates. The Canadian dollar's reacting, capital flowing out of Canadian assets into U.S. And I think there's more of that to come, as I mentioned, because there's still some spread there that could be taken away.
Okay, as our inflation rate comes down or our rates come down.
Correct.
Yeah. The Fed staying pat, and you think they might do that right through the spring?
Yeah, I think, the narrative right now is that the U.S. economy is still doing well. And there's some U.S. exceptionalism going on. GDP growth is doing well. The job market's doing well. Wages is stabilized. Inflation, the PCE indicator that the Fed likes to look at, is still at 2.5%. So they said it today, the risks are roughly balanced. And when they start talking about balance, that means that they're going to be on hold. So I think that's where kind of the Fed is positioning itself. I think the bond market has actually kind of internalized that already. We've actually seen U.S. Treasury yields go up in the face of two cuts by the Federal Reserve. It seems kind of disconnected, but I think the bond market is smelling the fact that inflation may be a little bit more, that growth kind of might be running a little bit more hot with the Trump presidency, things like that.
And again, Jay Powell, we heard from a guest today that he's almost Trump dependent these days. He's got to wait to see what happens.
Well, I think that's the playbook by the new president, make everybody dependent on what he says. And certainly that's worked for him, as the art of the deal goes, right? Yeah. So we are all probably just waiting to see what happens in terms of that. And obviously, there are political ramifications and how people vote after the fact, too. So, I think Mr. Powell's going to be judicious and act like a Fed governor and not get political, even though Mr. Trump might be kind of rattling him to cut rates and things like that. So it's going to be an interesting environment.
And maybe, I'm not sure if we've time, we could look at a chart for the U.S. 10-year bond yield. And it has moved up a bit over the past few weeks.
Yes, absolutely.
Investors are, and apparently this is partly just the so-called term premium, which is really just a risk premium. People just don't know what way the markets are going to go.
Well, we did a little bit of a study and looked at the 10-year U.S. Treasury going back all the way to 1875. And a lot of investors, people in my industry, real estate folks, are all saying, well, maybe because of Trump, we might have to deal with higher for longer. But the reality is, when you look at the movement up of that 10-year Fed Treasury yield, it's moved up to just over 4.5%. That's actually the long-term average going out all the way to 1875. So maybe this is not just higher for longer. Maybe this is a return to the old normal. And if Trump does something else, maybe we go even a little bit higher.
So historically, the market wants 4.5% from U.S. 10-year
debt.
Yeah,
and I think that term premium is part of the story. You know, it was driven down to very, very low levels over the last several years, and a couple of factors added to that. And one of them was a global financial crisis and a global pandemic, right? Those are once-in-a-lifetime sort of situations.
Yeah, we have to kind of remember that.
Yeah.
This century has seen some wild events.
Exactly,
Yeah.
exactly.
Thanks very much indeed, Carl.
Thank you, my pleasure.
Carl Gomez, Chief Economist.